Buying a home is a dream that many people will have at some point in their lives. You may sometimes feel like it's impossible and tell yourself, it was easier in your parents' time or even 5 years ago. But when it's really your dream to buy, there are ways to make it happen. First, you have to make a budget to know exactly where your finances are at. No, there's no getting away from making a budget, especially if you want to make such a big purchase. If you have any debts, they'll be taken into consideration during the mortgage qualification process. It's also quite important to calculate your assets to know what you can afford to buy. Whether you want to buy a mansion or a tiny house, you'll have to save before you buy. And the sooner you get started, the better, because this kind of money won't just appear with the snap of a finger. It all depends on the down payment you need. The higher your down payment, the smaller your mortgage, and the less interest you'll have to pay. In general, the recommended down payment is 20% of the property value. We understand that 20% is a lot in the current market, especially for first-time home buyers. If you don't think you'll be able to save that much for a long time, no need to get discouraged. There's a solution. If you qualify, you can use the mortgage loan insurance. In that case, your down payment can be as little as 5%. Mortgage loan insurance is insurance that is used to protect the financial institution that provides you with your loan in case you're no longer able to make your payments. You can get this insurance from the Canada Mortgage and Housing Corporation, otherwise known as CMHC or SAGEN. Premiums vary based on the down payment and must be paid at the time of your purchase or are added to the loan amount. Yes, it's true. It's not fake news. If you have an RRSP, you can use part of it to buy your first home using a government program called the Home Buyers Plan, otherwise known as HBP. It allows you to withdraw the funds from your RRSP under certain conditions to increase your down payment. It's a good option because the HBP allows you to withdraw up to $35,000 from your RRSP, and that would mean $70,000 for a couple for the purchase of their first home. And what's great is that you pay no tax on that money in the year of the withdrawal and even have up to 15 years to pay it back without any interest. It's like taking out a loan on your RRSP. Of course, the sooner you start contributing, the more money you'll have available to take out. Yes, there are definitely other expenses to consider besides mortgage payments. They're called startup costs. They can be high, usually between 3% and 5% of the price of the home. Startup costs include inspection costs, legal fees, land transfer tax, and other expenses such as hiring movers and getting your electricity and internet hooked up. Don't forget about condo fees or maintenance costs for your new home. Eventually, you'll need to redo the roof, and you may want to replace the windows, renovate a bathroom, or build a new patio. It's not a good idea to sweep these potential expenses under the rug. You have to plan for when you'll eventually need to use the savings or think about new financing. It's definitely a lot to think about, but by anticipating expenses and planning for each step, things become clearer and the dream of owning a home becomes a possibility.